Aloha, everybody. This is Na Lan. I'm your host today. Welcome to this session's Condo Insider. Happy Valentine's Day. We're pre-recording for February the 16th. We have our guest, Ms. Sue Savio of Insurance Associates today. We're going to talk about association, insurance, and risk management. And with this session, we're going to learn about how the associations can take effective measures to improve your insurability and keep your insurance costs down. Welcome, Sue. Thank you so much for taking time out your busy schedule to speak for us today.
Thank you for having me.
So it is association insurance renewal season again, right? I'm sure you're busy. And what trend or new challenges you see this year for a lot of the condominium associations and community associations in Hawaii?
There's a lot of challenges this year. We have a hurricane exposure that we don't have the capacity for. We have the directors and officers problems. We're having problems with our umbrellas. And we're also having problems with the actual property rate because of the cost of construction and increased cost of valuation. So all of these 5 things are just creating turmoil in the insurance industry. 2021 was a terrible year for the insurance industry worldwide. But in America alone, which we are a part of, they paid out $120 billion in claims. And of course, that's affecting even Hawaii's rates because we all use the same reinsurers. And just for the audience's sake, a reinsurer, for example, if you take the Marco Polo fire, First Insurance only had the first $4 million. They reinsured the other $96 million and more because it was a $200 million building. And they buy reinsurance so that if something goes above the $4 million, the other carriers are paying for it. So when we say out of the top 50 reinsurers that insure throughout the world, 34 of them lost money in 2021. And that's not an insurance company's goal. They have to make a profit so that they're to pay the claims. So because of that, property rates have skyrocketed. Then on top of that, we have the problem with the hurricane. All of a sudden, the capacity to write hurricane, a company a year ago who would give us 25 million, this year is saying I can only give you 5. So you're out layering more and more of the hurricane costs, which makes it more and more expensive. And also on top of all of that, we have the fact that the cost of building has increased by about 30%. So this is making things very expensive for anybody who has a large building like a condominium. So that's the property end. Then we've got the umbrella end. You take that Florida condo that collapsed, the 1.2 billion paid out, only 25 million was property. The rest was all liability, umbrella carriers from all different, the persons who managed the complex, the security guard who walked the grounds, everybody's umbrella paid out. And then if you take the Chicago, Nevada, Las Vegas shootings, that was a 751 million payout on umbrellas. So what's happened is a market that used to last, right, for the last 20 years, our umbrellas closed down and said, forget it, we're not writing umbrellas anymore. So even now, umbrella premiums have skyrocketed if you can get an umbrella. And so that's another problem we have. And then in Hawaii, we have our directors and officers problem because we used to have 5 main carriers that were writing our business. And all of a sudden, 2 of them left. The others are putting more restrictions on their policies, plus increasing their premiums because they've lost money. So it's really been a very stressful year, not only for the owners who have to come up with the dollars, but for us as agents trying to even find the coverage. So not good is the best way to put it.
That's a lot of information. And we actually do have a lot of new directors coming on board this year. I guess for our audience, let's back up, cover the basics of association insurance. So typically for a condominium association, what kind of insurance does the law require the association to carry?
Okay, so the law and your bylaws and the condo statutes, if you have property that the association owns, it could be a high-rise building, it could be nothing but a gate, or it could be nothing but your name on a plaque outside showing where your property is. You're required to insure your buildings or your property as originally built. So you've got to buy property insurance. And of course, you're required to carry by the banks hurricane insurance because we are a hurricane state. Besides fire and lightning and windstorm, you've got to have that hurricane. So that's the property piece. The bylaws and the condo statutes go on to say you have to carry general liability. That's all the common and limited common areas. Someone slips and falls, the gate hits somebody's car, someone gets hurt at the pool, whatever the case may be, you have to have liability insurance that covers the association as a whole, covers the common and limited common area, does not go into the unit. That's still the person's personal policy. Then on top of that, you've got a board of directors that are serving. They want to be protected after all. So you're allowed to buy directors and officers coverage. So that in case something goes wrong or something doesn't go wrong, but somebody thinks it's wrong and they sue the board, you've got your defense there, as opposed to having to go to the owners to say, cough up the law fees and any settlements. So you buy directors and officers. And of course, if you're in a flood zone, a mandated flood zone, you have to buy flood insurance. So there's those other additional coverages you may need. But the main ones are property liability, the umbrella, because you've got lots of people's assets that you're protecting, and the directors and officers. So those are the basic things that you're required to carry.
I see. What is the fidelity bond certain associations have to carry? Actually, everyone, right?
That's right. I forgot about that. Thank you for reminding me. You do have to carry a bond by condo statutes. And what that does is protecting the association's money. In other words, you're putting maintenance money aside for not only everyday expenses, but for the future. And that money is being stored somewhere in a bank, but still things can happen to money that's being stored. There's a lot of internet theft and things of that sort. So you have to have a bond that protects your money because it's the association's funds and you need that there to cover your expenses. So you are required 6 units and more to carry a fidelity bond. And thank you for reminding me of that one.
Thank you. Yeah, so for the directors who are not familiar with this, you can find all these information also in the chapter 514B, section 143. That could be a useful reference for you to go to. Well, we often in condo context, we hear a lot about HO6 insurance and H4 insurance. What are those two types of insurance?
Sure. Okay. An HO6 is a personal policy that every condo unit owner should have. Now, there's not really anybody making sure you have it. But remember now, the master policy covers as originally built. But you've upgraded your kitchen. You replaced the carpet with a beautiful wood floor. If there's a fire in your unit, we're only going to give you the as originally built. We're going to give you carpet money. We're going to give you a basic kitchen, not the beautiful koa wood with granite marble or whatever you have. So your HO6 says the master policy stops here. We have your upgrades covered. We have your loss of use. You can't live in your unit like the Marco Polo. Some people for a year or more. You need to go rent another place. It's called loss of use. Your HO6 covers that. It covers your upgrades, your contents, your loss of use, and your liability. So whether something happens in your unit or you're out golfing and you hit somebody with a golf ball or your dog bites somebody in the common elements, it's your HO6 that's protecting you and your family. So the master policy covers you as a member of the association, but it does not cover you as an individual. And that's what the HO6 does. It gives you liability protection and fire protection. You can purchase hurricane, though you have to purchase it probably separately because most HO6 policies don't have hurricane on it. But it's covering your contents, your upgrades, your liability, your loss of use. And that's what the HO6 is taking care of you. And it's a relatively inexpensive policy, maybe $300-400 a year. So it's well worth it. But again, you have to buy it as an individual. And I always tell people, go to your auto carrier, put the 2 policies together, bundle them up. You might get a discount. That's the best way. And if not, then there's always agents that will sell you just the homeowner's policy. Then the master policy, remember, is as originally built. So the HO4 that you mentioned is a policy for tenants. So I'm a landlord. I rent out my unit. I carry the HO6 for me as the landlord. I don't cover my tenant's property. If my tenant sets the place on fire, I am, as the landlord, I'm going to be charged the association's deductible. But if I make sure my tenants have coverage, their policy will take care of that. The fact that maybe there's a water leak from the unit above and my tenant can't stay in the unit, if they have an HO4, their policy will give loss of use. It will give them money to go rent elsewhere so they can continue to pay my rent and keep the unit open for themselves. So the HO4 for tenants, the HO6 for every condo unit owner. Those 2 policies are very important.
Thank you so much for the explanation. You just mentioned the deductible on a master policy. That is usually just for the property insurance, right? How does that work when you adjust for a claim made on the policy?
Okay, so every policy has a deductible. The typical, when I started in this business, $1,000 was the typical deductible. Then it went up to 5, and then it was at 25. And we have some companies now that will write nothing below $75,000 as a deductible.
Oh,
Okay?
wow.
Because there's so many water claims, millions of dollars, $30-40 million my agency pays in water claims a year. I file 7 to 10 water claims a day. So that's the insurance companies are tired of it because we have old pipes. We're not taking care of our appliances. So they're putting these high deductibles on it. So that deductible, if my unit causes a claim, let's say I'm cooking, I set the place on fire. Okay. The $75,000 deductible, let's say it's a $200,000 claim, it's just a kitchen fire. I'm going to get $125,000 from the master policy. And the units below me have water damage. The units above me have smoke damage. Those people, the innocent people, are going to be paid first. And then I'm going to be short that $75,000 because they're going to say, well, Sue, you caused a claim and we only have $10,000 left over. I need to be able to go to my carrier, my HO6 carrier, and say, I'm being assessed this $75,000 deductible. I need you to pay it for me. And then they'll give me the money so I can put my unit back together. They'll also give me my contents that got ruined. They'll also give me the loss of use to go stay elsewhere while they put my unit back together. Now, when it's a water claim, there are many a time when my ice maker is leaking, it's going to the unit down below and there's no damage to my unit, none whatsoever, because it's going down. I'm still going to be charged that $75,000 deductible. I'm still going to have to make sure my policy's got that protection. So when I get the letter from the association that says on such a date, your unit caused the claim, we're assessing you the $75,000 so we can take care of the innocent units below you. I have to be able to send that letter to my insurance company, who will then pay that $75,000 minus my personal HO6 deductible, which is usually about $500. Some people have 1,000, some have 2, but it's much smaller than the $75,000 that I'm looking for. So I will still be out money, which is fine. I caused the claim, but I will have the bulk of my assessment letter sent to my insurance company so they can pay the association. So that's usually how it works most of the time. Now, 514B, what you mentioned, 143, does allow the board to do 3 things with a deductible. They can pay it. They can charge it to the causative owner. I caused the fire, I pay it. Or they can split it amongst the owners receiving proceeds from the claim. So if it comes from a common element, we don't know whose kid's toy that was in the common element that caused it to back up. The board usually will then say, okay, you 3-4 unit owners, we're splitting the deductible amongst you. Sue Savio, you got 50% of the claim, you get 50% of the deductible. Na, you got 10% of the claim, you get 10% of the deductible, and so it goes on. And then we get that assessment letter, again from the association, where we go back to our own carrier to make up the money that we've lost. So the 3 ways the deductible is handled, and believe me, most of the time it's the causative owner and then to the owners receiving proceeds from the claim.
Yeah, so the policy Sue just mentioned, insurance deductible policy, actually doesn't need ownership approval. The board alone can vote and decide on it. This is a very useful policy for unit owner to resolve basically disputes among unit owners or disputes between unit owners and the board, in cases, losses occur. As we said, there's so many water claims.
Yes.
It's absolutely necessary to have this policy in place because otherwise, you're going to spend a lot of your legal budget on this kind of thing when one written policy in place could have, much more efficiently get everybody on the same page of what should we do when that thing occur, right?
Exactly.
So besides of this one, I think in section 143 of the chapter 514B, there are also some other useful tools that can be utilized by the association to basically really help try to reduce your losses, reduce your, accidents in the building. For example, the mandatory unit insurance requirement, right? Sometimes we call it HO6 mandates.
Right.
And how does this work?
Okay. If the owners, 51.1%, have opted in, the board then can force all owners to have an HO6. and they can actually monitor it and check it. And if an owner doesn't proof of one, the board can actually buy it and charge it to that unit owner. Now, the reason for this is to protect that unit owner from the fact that they may have a $75,000 deductible tacked onto their unit because they caused the claim or their unit did. So that's why it's so important that you have that HO6. And when owners can't get everybody to show proof on their own, the board then can say, all right, owners, let's opt in, let's do this. We're going to make sure everybody has an HO6. It's with minimum limits. It's just enough to cover all the things that could go wrong, the basics. It's not enough if you have a high dustied up unit, but it's the basics. And it just makes sure that at the time of claim, there's somebody to pay that association deductible.
And we also have in 514B, we also have a section 138 specifically on high risk components policy. And what is that?
That's an excellent tool as well. It allows the board, with notification to the owners, that certain items are going to be high risk. Now, for most condos, it's water-bearing appliances, because those are the things that leak. So it's the toilets, it's the washing machine, it's the ice maker hose. But for some condos, it may be the right to make sure, because they don't have sprinklers, to make sure that they have a smoke detector, an operating smoke detector in each unit. So that could also be on your high-risk inspection. So you can add things. I have a condo that adds the roofs on, because the owners are in charge of maintaining the roofs, but again, they don't know if they're doing it. So every now and then the association wants to send a roofer out to check all the roofs. So that's part of their high risk inspection. So it's up to each condo to determine what's important to them. And for most, it's always the water-bearing appliances, and then they'll add on things. And if you don't have sprinklers and an up-to-date fire alarm, they will check on that smoke alarm. Or sometimes they have water alarms on the appliances. They've given out water alarms. They want to make sure that they're still working, that your batteries are up to date and things of that sort. So it's a good tool.
Yeah, and this is also one of the policies where the board alone can vote and approve it, right? And make a sound business judgment for your building on behalf of the unit owners. You don't have to, have owners vote on this at the annual meeting or try to send out, ballots to get written consent forms. So, if your building hasn't done that, this is also highly recommended when we're already facing with such a crisis situation on insurance, with rising costs and also, so little choices now, right?
So little choices.
Yeah, exactly. So, we're talking about, the second part of our topic today is risk management control. If you can explain further about this concept and how does it work for condominium associations so that our board directors, our property managers can, consider for their projects.
Okay, so risk management is literally looking at your complex, having sometimes the insurance company will send a loss control representative out to literally walk your grounds. I know it can be irritating. It takes the resident manager's time. You've got to show him around and literally go through a whole host of things that he'll find wrong, or that could be a potential claim for your association. They then send you a list with all the things that you need to correct and how to correct them, because they're not interested in paying claims when it's something that can be maintained. And it's important. The board's job is to maintain your complex. And if you don't maintain it, then you're going to have claims, whether it's the roofs leaks, whether you're going to have your holes in the ground where people slip and fall, whether your gates locking correctly at the pool, which is a huge liability. So in other words, the loss control rep goes around and presents things that can be done. The association can check themselves as well, because the loss control rep's not coming out every day to your complex. They're going to come in intermittently every year or so, or 2 or 3. In between, your own board or your own resident manager or employees who are walking the grounds need to know that there's a hole in the ground, or that a sprinkler is shooting into a unit, or whatever the case may be. You want to make sure that your complex is as safe as possible, that you don't have slippy areas with moss on the ground, on the grass or on the concrete where someone slips and falls. You want somebody to clean that up. So it's really just important. It's just looking at what you have, looking at your building, your grounds, and keeping them as safe as you can, so that your claims are less, your premium stays down, and you got more than one company that's willing to write you because you're a good risk. And they get to see your losses for the last 5 years every time we go out to bid. And if they see that you hardly have any losses and that you're well maintained, then they're going to want to quote you at their best rate, as opposed to the person who has a leak a week, who has slips and falls, who had someone get hurt at the pool, whose tennis courts are full of weeds. Obviously, they're not maintaining. Those are things that show up, or lanais that are crooked. So you question whether they're structurally sound. There's all types of things they're looking for. So loss control is very important, and it's important that you follow through as board of directors with the correct people to fix the problems before it comes to claim.
Yeah, I think, ideal situation, the board, would want to try to keep every item well maintained and, like reduce the risk for every item. But unfortunately, in the real world, we have, basically inflation economy. A lot of the repairs maintenance are costing much more, but every association has a limited budget and reserves for many of the items. So then it comes to really, how do you prioritize all these risks identified? What is your suggestion or tips based on your industry experience here?
Okay, I think you're right. There is a limited amount of money that anybody has. And of course, reserves weren't put into effect until the 80s. And now they used to be only 20 years, and now they're going out to 30 years. So, and of course, we don't have pipe money. And that's the biggest issue right now, along with sprinklers for the buildings that don't have them. But most of our older condos, and like 90% of our condos were built before the 90s, don't have pipe problems. They're going to have to replace those pipes. And it's expensive. It's $4, $5, $6 million. You can't save for it. You have to understand the minute rates go down and you can borrow money from the bank, you've got to do it, because you can't continue on having 2 and 3 claims every month, because nobody's going to want to insure you, because all they're doing is maintaining your building for you, because as the pipes break, you're replacing the pipes short term. We're taking care of all the damage under insurance. It just is not the way insurance is supposed to work. It's not supposed to be a maintenance policy. So it is tough in how do you say, what can we do? The thing is to look at your losses and see where they are. Are they in appliances? If they're in appliances, then it's get on the owners, get a high risk inspection going. Make sure that water heaters are changed every 10 years. They only last 10 years. Make sure that, you have copper hoses for your ice maker. There's certain things you can do. I have a condo with that. Anytime a new appliance, washing machine comes in, they take off the rubber hose and they give them a flood check hose. It's a braided hose that, is much stronger than the rubber hose. They've never had a washing machine leak because they do that. It helps. I have other boards who have bought water alarms. They're like a smoke alarm, but you put it down under the sink, under the water heater, and around the toilet. And so the minute there's any water that leaks, this alarm screams, holy hell. And you know that there's a water leak and you can stop it instantly. And even if you're not home, it is so loud, your neighbor will hear it through a concrete wall. Okay, because I've had people go by a unit and hear it ringing, call the resident manager, who then will go in and find the water leak and stop it before it leaks for 3, 4, 5 hours while you're at work. It really, things like that are going to help you maintain. And even if you've had losses in the past and we're trying to bid your complex, if we can say, yes, they had 6, 7, 8, 10 water losses last year, here's what they've done. They did the plumbing inspection. They did the water alarm. They, scoped their pipes, or whatever the case may be. The more you give us as agents to say the good things about your complex, the better your rate will be. But you've got to be willing to do these things. And you've got to say that even though we don't have the money to buy water alarms for everybody, maybe we don't want to spend the money for a plumbing inspection, you may have no choice. Okay, because even if we can't place your coverage in what we call the standard market, and we have to go to what we call the secondary market, who will charge 3 to 5 times as much, they still are going to demand these things, or you will have no insurance. Okay, so it's really, or you'll have such high deductibles, a $500,000 deductible, that that's the only thing they're going to cover is fire. And there is a complex with a $500,000 deductible in our state. So, I mean, and that's very hard as a homeowner to insure for. So It's really important. There are some things you have no choice, and you have to accept the fact that this is an investment. This is your home. This is your biggest asset, and you cannot afford to let it deteriorate. Okay, that's what happened in that Florida condo. They let it deteriorate, and now nobody has an asset. And we've lost, 90 lives or something. I mean, I don't want to be insuring that condo in Hawaii when it happens. I want everybody to bite the bullet and say, we can't afford this, but we have no choice.
Great information. Thank you so much. So you must have had examples where, associations, they listened to your advice, they took those effective measures, and are they able to improve on their insurability, or to what extent they can really reduce their insurance costs? Can you give us some examples for
I
our
sure
boards
can.
out there?
I can give you an example. I had a complex, I won't mention their name. They were having a leak a week. But we wouldn't report them all because it might be below the deductible. We didn't want to alarm the insurance company too much. So it was about a third, it was about 44 years old. It went ahead and replaced its pipes. Expensive. But they decided, since people can't see pipes and they had to spend all this money, they fixed the pool up and they put some money into the lobby remodeling. And so they did some things that people could see. So even though I'm paying on a $17 million loan, right, I can see that, wow, look how pretty my pool area is. And I got beautiful gates and the lobby's been remodeled. Yes, it's my pipes that I don't see. So their premium, which was $90,000, went back down to $60 the following year. Now, $30,000 is not a lot when you spent $17 million, but you had no choice in spending that $17 million. And because your claims went down, the insurance company can say, okay, they did the pipes, they're taking care of things. We now can offer it at the low rate they used to have it at. Okay, so that's important. So it does happen, but it takes time, because while you're doing your pipes and while you're doing all the things to pass, the rate is still high because there's more claims while this is happening. So it will take time, but it will go back down to the good old days when it was, almost a claim-free building. And to this day, it's only had one other claim. That's pretty good.
Wow. Yeah. But I think for a lot of board directors, the last thing they want to do is raise, maintenance fees. But unfortunately, in today's economy, that's almost like guaranteed, and it's necessary. And to the other extreme, if you keep kicking the can down the road, do nothing, ignore this issue, do nothing on risk management control, under that circumstances, what's the worst scenario for your building, for your association?
Okay, if you keep on kicking that can down the road, your claims are going to get even worse. Your expenses to repair, it was cheaper 10 years ago to put your pipes in than it is this year. It's going to be cheaper to put it in this year than it is 5 years from now. Nothing stays the same or gets less. So I think the thing is to bite the bullet and do what you have to do. I'm a board president of a condo that's just 6 stories, but we were sat vacant for 10 years, a business building. We then converted it to a condo and we moved in, but our reserve study made us sound like we were a brand new building. Well, we weren't. The air conditioning was already 10 years old. And so when we redid the budget to reality, we increased our maintenance fees. I had the pleasure of increasing our maintenance fees 40% one year. There was no way of getting around it. I looked at what we had to pay, what the expenses were. I divided by the number of units and the percentage of common interest, went to the board and said, here it is, 40% increase. Did they scream and yell? Small building, most of us were on the board. They sure did. But they saw the figures and they said, this is the reality. The following year, our air conditioner of $350,000 gave out. You can't have a building with no windows and not have air conditioning and people working in it. So we had to spend the $350 sooner than we thought to fix that. Then, of course, we had issues with the paint. It was time to paint the building. 6-story building should be $700,000, $600,000, $1.2 million to paint a 6-story building. They painted the high rise across the street from us for $1.3 million, and it was 40 stories. What's the difference? We're a little building that has a lot of nooks and crannies, and you can't just whip down on a scaffolding and paint the building. So it was almost as much as a high rise. So you have to be prepared for these things. Otherwise, we're going to have to assess. So don't say you can't do it. You can do it. They'll be mad at you. They in fact scolded me by saying I'll be board president for the rest of my life. Okay, that was my punishment for admitting we needed to raise our fees. But at least they could say you were right. We had the money to fix the things we needed to do. So that's what the board president, that's the board the way you want to be. Board of directors who are listening, you want to be the one that says, I did what was right. And let's go back to that Florida condo. 15 years before it fell, that board of directors was assessing owners. They wanted to assess owners to fix the building up, structural effects. They were overthrown by the other members of the board, other members of the association. I would have been proud to have been a member on that board and been overthrown because I was doing the right thing. 15 years later, that building falls, and they should not have happened. They should have realized they knew they had structural problems and they didn't take care of it. So I tell all of you who are out there who sit on a board, if you're an owner, you cannot let your board get away with not increasing maintenance fees. Every year, the cost of living goes up. If you haven't increased your maintenance fees, at least the cost of living, you're doing a disservice to your owners, because someday you are going to have to increase it huge and they're not going to be happy. It is better to have a 3, 6, 5% increase annually for the cost of living alone. Never mind the projects that you have to do. But if you're not going to be realistic about it and you're not going to follow the hard road and do what you got to do, you should not be a board member. Just become an owner, be in the audience and grumble at the board for raising the fees, but let the board do what they have to do. I've been on a board since my 20s, and I've seen all kinds, and I can't tell you how important your role is. Do what you have to do, not what's going to make you polite around the project. Not everybody's going to be thrilled to see you. Let them be upset when they see you, because you're doing what you need to do. Don't be that old Florida condo board, not the new one that didn't get it done. That's what I have to say.
Thank you so much. Our time is up today. We want to thank our insurance expert, Ms. Sue Savio, again for taking the time, sharing some really useful information on how your association can improve insurability, keep insurance costs down. Just watch our show and listen to Sue's advice and start acting. Just do it. We can definitely, you are elected in the role to be the guardian of all the investment of your building, your fellow owners, neighbors. So thank you again. Thank you, Sue.
Thank you so much for watching ThinkTech Hawaii. If you like what we do, please like us and click the subscribe button on YouTube and the follow button on Vimeo. You can also follow us on Facebook, Instagram, and LinkedIn, and donate to us at thinktechhawaii.com. Mahalo.